Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Neil Barlow. He is partner at Clifford Chance, as well as Ira Gorsky, managing director of special situations and investor relations at Edelman. We're here to discuss how macroeconomic trends are impacting deal making, investor appetite, and corporate valuations. It is great to have the both of you with us. Welcome to Trade Talks. And Neil, I think it's fair to say that the landscape is very different than perhaps we might have expected for 2025. There is more volatility in the macro backdrop.
Most definitely, Joe. I think there's still a lot of uncertainty globally and domestically here in the United States. I think what we're seeing is there was an anticipation going into 2025 that there was going to be a real uptick in M&A activity, both private and public. And I think what we've seen is people readying themselves to transact, but that hasn't quite happened yet, given the amount of change that is going on, particularly that we've seen in the last few weeks domestically here, but also, of course, with what's happening around the world. Yeah,
and Ira, would you say it's because of interest rates for longer, uncertainty around tariffs and other trade policy, or is it a culmination of all these things?
I think it's a confluence of events. Like typically, mergers are a risky venture, even in the most stable environments. But now you have to worry about second order, third order effects. People don't know where tariffs are going to wind up. People don't know if the initial positions are maximalist negotiating positions. Then there's other elements with interest rates where you have also conflicting information in terms of the debt's higher than it's ever been. We're paying basically $950 billion a year just in interest. But then we have lower participation in the workforce. And you could have also strains of companies where they're having productivity gains. So people don't have a good sense where things are going right now.
Yeah, and if you think about advising people, as you're planning these transactions and figuring out what policy is going to look like in all these other macro pressures, it's got to, I'm curious to hear what you're hearing from clients and companies in terms of where they're focused, what keeps them up at night.
Certainly running afoul of the administration is definitely a big thing, because you can be targeted directly, and you also could be targeted from the other side by AGs. Mm-hmm. And your move forward is going to upset anyone. There is no clear path. Mm-hmm. So you're picking the best risk reward as you proceed, both from a capital allocation and politically.
Yeah. Neil, would you say in terms of deal making activity, public or private, what is showing more promise or more activity, if you will?
Look, I think the private markets still intend to transact pretty heavily this year. I think it's quite sector specific. Mm-hmm. I mean, if you look at the sports entertainment sector, the fintech sector, they are generally resilient to some of the headwinds we're seeing. Whereas if you're looking at AI, data, to Ira's point, then actually is now the time to transact, acquire businesses. And even if you're a seller of a privately held business, is now the time to sell from a valuation perspective. Are you going to be able to maximize your returns? Or do you need to flip it and bring in a strategic investor alongside to kickstart the next layer and period of strategic growth? I think on the public market side, we are starting to see movement on the IPO front, but also around take private. So again, the private business is looking at, can we consolidate? Can we move a business in that actually we may have been contracting with in the tech space, with inflation and interest rates paying increasing amounts? Can we consolidate even as a public company and bring that division in? So we're seeing lots of thoughts around take privates and spin-offs.
Yeah, well, I mean, when you think about it, we had that valuation reset not only in the public markets but private markets, right? Following, in that 2022, half of 2023 period, which I think had to happen to get valuations back down to earth and think about operating priorities and what the balance sheet looks like. So it also depends when your money has gone into these types of investments as well. You have to start to turn these investments over.
No, there's definitely pressure. I think people that held on to businesses because they had to, particularly during the pandemic period when we saw a lot of movement in the healthcare and tech space in particular. People that have held because they say, well, it's an industrials business, this is not the time to sell. We're hoping for a real uptick economically. And I think we've seen challenges and geopolitics has been part of depressing some of those valuations. So some of our clients have said, well, we're going to hang on to this business for longer. We're going to develop it into new territories. We're going to understand how these headwinds affect that platform and what is the right future for this business.
Right. Well, I mean, that could be a good thing as well when you think about it from a leadership and operating perspective. I think some of that was lacking in the run-up in some of these valuations.
Yeah, and the valuations are going to always be difficult because you've got to make a very long-term assessment of where things are. And some of the things that are shorter term that have a lot of enthusiasm from the market in terms of multiples will pull back, and those are harder to make those bets. Some of the other things which I think are long duration that transcend politics is infrastructure investing. So infrastructure investing, I think, is, regardless of the administration, it's going to need more than a 4-year time frame to come to market. One of the recent examples is we just worked on Argo Infrastructure Partners, which sold to Apollo. And Apollo has been very deep into the space, and they're expanding. And you're going to see that from other infrastructure companies as well.
Yeah, well, that's a good point that you make. When you think about policy through a 4-year lens, these projects are highly capital intensive, and they could take anywhere from 5 to 10 years to complete, assuming all things are running on 8 cylinders.
Exactly. I mean, that's one of the reasons why we haven't seen more nuclear. Is people talk about it, but it's an investment cycle that is too uncertain for people to invest in, but eventually the macroeconomic forces push people to make those type of decisions because it makes sense on too many levels.
Neil, it's interesting. You wonder if the AI story that really came to the forefront, what was it, November 2022, around generative AI applications, it makes you wonder what the environment would look like on the public and private markets if that narrative wasn't in the market. I mean, to your point earlier, or I'm sorry, to Ira's point earlier, the valuations just took off because there was a story and there was something new in there because we already moved on from the fintech story.
I think that's right, Jill, and actually that uncertainty now continues around how sustainable is that platform. What are the competitors? Where are the competitors coming from? Are they coming from outside the US? What does that mean to a public company stock price? What does that mean if it's privately held? What's the longevity? And actually, how does that get developed? And then there's a race to make sure that they have the right data, the right technology, the right systems to take it forward. Otherwise, to your point, valuations could really drop.
Well, we're talking about a 4-year timeline here. Is it the expectation that policies are going to continue to shift every 4 years? I mean, that's a really tough environment to think about.
I think it's really hard to know, right? And I think as things settle or potentially settle, we're going to have to figure that out, and our clients are trying to figure that out. I think it's very sector specific. To Ira's point on infrastructure, that's pretty bipartisan. There is a critical need to invest in fundamental infrastructure in the United States and beyond, and I think that's in the national interest, and I think that will continue to be encouraged. When policy affects tech businesses and AI around cyber safety, what does it mean about foreign influence? That's when there comes a question about how do we understand how policy affects M&A deal doing.
Right, and speaking of, there really isn't a clear framework around AI, cyber, as it stands right now. We're still formulating what data policy is going to look like, because as Neil had said, it's more than just innovating and winning in the capital markets. It's national security, issue and being able to source to satisfy this demand.
Yeah, and there's going to be certain things that happen. AI is an emotional cycle, but the build out of data centers is unquestionable. We need more capacity. And if you're going to have more data centers, then you're going to need more generation, and you're going to need more transmission. And so some of our clients have done very well in the transmission space because it has to occur either way, regardless of your political views. No one wants your power to go out. Right.
And then how do you triage those resources, right? Because the technology is developing way quicker than these projects can for a number of reasons. I just, again, going back to that, are we going to rethink what this looks like every 4 years? I mean, how do we fix that?
Well, there is going to be some things that are geopolitical that feel very volatile at the moment, but from a secular move, it's moving in a direction where the United States is retreating from the world stage. Like this is my political view in the sense that The United States is more insular, has more resources, land, food, energy, and there's going to be a general pullback over time. That's why infrastructure, onshoring of manufacturing will eventually get more capital and get more M&A.
Yeah. Do you think, Neil, do you think that will impact how we do deals here if we become more insular and it shakes up what the global trade and integration of all this? How does that impact it?
Great question. I think we're definitely seeing it impact cross-border M&A. So the world has clearly become a smaller place when it comes to trading and M&A. You look at the United States, you look at Europe, you look at parts of Southeast Asia, and really it's focused on that corridor right now. If you look at the amount of inbound M&A 10 years ago into the US from China, that has decreased from around $200 billion a year to around $30 billion a year, which is a huge drop, right? And so when it comes to working out what business to acquire, and if you bring in the concept and the uncertainty at the moment around tariffs, then actually is this business that could be headquartered in the US, is it reliant on a supply chain from countries that are going to be adversely impacted by tariffs? And what does that mean when you think about growing or selling that business? And if you're going to sell it, do you need to reorganize the business geographically to make sure your supply chains are more insular, are more domestic? So it will definitely have an impact on the global playing field of mergers and acquisitions.
Yeah, and we've seen that, in more recent years where there's a shift out of the supply chain out of China, and you're seeing it shift to other areas such as Vietnam and India and so forth. So that was already in motion, but again, these are not easy things you flip on a switch and it just happens. I mean, it's a lot to re-engineer your manufacturing.
It's a lot, and I think that is one reason why we are seeing a cautious approach from our investor clients as to their M&A so far this year. I think people anticipated with an administration change, with the potential for less regulation, but that there was going to be a real uptick. I think actually Q1, Q2, we're in a kind of let's figure this out. Let's see where this ends up, and then let's see if Q3, 4, and beyond there is more certainty as to the sectors that are going to be attractive to doing M&A in.
Well, let's talk more about that because there was the announcement a couple weeks ago with the FTC and DOJ, which I don't think people were expecting from a business perspective. It's a little bit more less business friendly than you would have thought.
Right. So for the audience, it's the Trump, DOJ, and FTC reiterated that they're going to keep the new merger guidelines that were instituted under the Biden administration. And those merger guidelines were a departure from the usual standard, which is the consumer harm. It brought in other elements such as labor and squeezing your supply chain and things like that. And you had raised a great point before, which is if you're doing cross-border deals, you need regulatory approval from the antitrust enforcers in another jurisdiction. It's the easiest way to express political unhappiness is by having your antitrust enforcers give it a hard time. So for example, Navarro was on CNBC today, and he was talking about the EU, the European Competition Commission investigation into US tech companies. And he was just viewing that as state-sponsored competition trying to keep down US companies. So that also, I think, is chilling cross-border M&A because if you're in a tariff war with the European Union, an easy way for them to retaliate is by having a protracted antitrust investigation.
Yeah, I mean, they've always had issues, the EU, with
our
larger tech companies such as Google, Apple, Microsoft. And I think that also comes down to fundamentally how the EU versus the US looks at things such as data privacy and content moderation as an example. Just fundamentally, they approach it in a different way. So that adds another layer of complexity when you're operating in a global environment. It's almost like when asset managers had to adhere to GDPR. If you want to be represented in the EU and manage European assets, you have to comply.
That's absolutely right, Jill. And the interesting thing is when we speak to our clients that perhaps operate predominantly in the US in some instances, actually what they're doing because they have touch points in Europe does actually translate back. So your point around GDPR, your point around increased regulation in Europe, and Ira's point around actually countries within Europe have become more insular and more defensive potentially as more regulation from other countries comes on board. And therefore, what's the response? And what does that mean for valuations? And does it actually create opportunity for investors to look at businesses in Europe? Because they'll say, actually, this is going to chill somewhat some of the valuations. It's now actually an opportunity to get in on the ground and to invest locally there and to build those businesses within the new global ecosystem of regulation, so antitrust, foreign direct investment, tariffs. And so actually I think it will also create opportunity.
Right, and because those valuations were much lower as compared to the U.S., we're seeing the performance of the European markets relative to the U.S. this year, which are far outpacing in terms of performance, because the risk was to the upside.
Right.
Right. So and it'll be interesting to see too that, you know, with the elections in Germany, Europe's largest economy, how that could potentially evolve the landscape as well.
Right, but that hasn't added any stability either.
Right.
Yeah, because in their parliamentary systems, in both France and Germany, neither of them have a solid coalition. And so they can't count on stability either. So it's going to be interesting, but in terms of capital formation and local investment, there's probably a higher, likelihood of that because then you don't have to worry about the cross-border. And so if the assets are cheap, the money will show up. It'll just be formed from different parties.
So if these, and the market's always going to climb some wall of uncertainty, but if a number of these are removed and we get clarity, what it looks like with interest rate policy and what's going to be with tariffs, you can understand the operating environment more. Does the pipeline look strong if you take all those away?
Yeah, so I'll give you the absolute bull case scenario. The bull case scenario is you look at the Trump administration and their rhetoric as maximalist negotiating positions, which is I'm going to say something which is going to get everyone's attention, shake the status quo, and then force a negotiation. And that the intention all along is a negotiation. And that once the markets and the governments have time to absorb this shock, then deals will be done. And then once the deals are done and people realize that that's how the playbook is running, the floodgates of capital and M&A will open. Yeah,
Neil, would you agree? Because that's one thing the market doesn't like, public or private, when there's an enormous amount of uncertainty.
No, I agree with Ira, Jill. I think, look, as interest rates settle, maybe don't go down, but actually they're around historical national average. I think people understand the parameters that they're now working with, and they say, particularly in the private equity space in which I operate, there's an incredible amount of capital that needs to be deployed for their LPs, and you have to make a move at some point. And once you get set on where inflation is, where the cost of borrowing is, and what that means, whether you're accessing traditional leverage finance, whether you're accessing the private credit market, which has obviously been very popular the last couple of years, then people are going to have to transact. I think that's going to mean a lot domestically because people will feel comfortable with obviously the largest economy in the world and the growth prospects here. And then opportunities abroad, such as in Europe and Southeast Asia, where valuations may be depressed, but that in itself will create opportunity for others.
Right, well, and you made a good point about interest rates as well. I think time and recency bias is something that we have to recognize as well. What we saw when the system was so flush with liquidity in ultra low interest rates, where we are right now and even prior to COVID, historically, this is what rates look like from a historical perspective. What we saw over the past, I would say since the financial crisis and, the unwind and how flush balance sheets were, that's the anomaly.
I would actually even go further in that inflation historically for the last 40 years has been depressed, and it's been depressed because of productivity. And steady state inflation is higher than what it is now, and in my opinion certainly higher than what it's been under COVID. And so there will be an increase in inflation. It's just natural, and and even if we onshore, there's going to be growing pains and upfront capital costs that inflation will rise, and then it'll moderate over time.
Yeah, well, there's always going to be growing pains in any cycle. All right, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.